The next market crash will not arrive with a warning that feels useful. It will not wait until you feel prepared. It will not care that your 401k finally reached a number that made you feel secure or that you told yourself you would learn more about investing later. And when it happens, most people will not suffer the most because they picked the wrong fund. They will suffer the most because they will react in the wrong way at the worst possible moment. That is the part almost nobody prepares for. Not the drop itself, but what the drop does to the person watching it happen. Because a crash is never just a market event. It is an emotional event. It is fear turning into action. It is people opening retirement apps they normally ignore. It is headlines built to create urgency. It is coworkers talking about getting out before things get even worse. It is the sudden feeling that years of discipline might vanish in weeks. And if you have a 401k, that feeling gets personal fast. What looked like a stable path to retirement suddenly feels fragile. The dangerous part is that a lot of people think they already know how they would respond. They imagine they would stay calm, keep contributing, maybe even buy more while prices are lower. But that confidence usually exists in good times. It is easy to say you'll be rational when the market is rising and your balance is growing. The real test starts when your account falls by thousands, maybe tens of thousands, and every headline makes it sound like something bigger is breaking. That is when discipline stops being a theory and becomes a decision. And if you stay with me by the end of this, you're going to see the next market crash in a completely different way. Not as some random disaster you hope to avoid, but as a moment that can either damage your retirement badly or actually improve your long-term outcome, depending on what you do before and during it. Because the biggest threat to your 401k may not be the crash itself. It may be the totally normal reaction that feels smart in the moment and expensive years later. Most people assume a crash hurts every investor the same way. It is not. Two people can live through the same downturn and come out with completely different futures. One sees the red numbers, panics, sells, and spends years trying to recover from the damage. The other sees the same drop, understands what is happening, keeps contributing, and maybe even rebalances calmly. Same crash, same economy, different behavior, different result. That is why this is not really about prediction. It is about preparation. And that matters because many people treat their 401k like background noise. Money goes in automatically from every paycheck. Maybe there is a company match. Maybe there is a target date fund. Maybe there are a few index funds they picked years ago and forgot about. As long as the balance keeps rising, the account feels fine. But a retirement account is very easy to ignore during calm periods and very hard to face during a violent downturn. That gap between inattention and panic is where a lot of damage begins. The challenge is not only that crashes are painful, it is that they reveal weaknesses you did not realize were there. They reveal whether your portfolio is more aggressive than you thought. They reveal whether you actually understand your time horizon or just assumed you had one. They reveal whether you have enough cash outside of retirement to avoid touching your investments during stress. They reveal whether your lifestyle is too expensive to handle uncertainty. A crash is not just a drop. It is an exposure event. Think about what your 401k really is. It is not just an account. It is years of your work stored in financial form. It is time, energy, stress, effort, discipline, and delayed gratification turned into a number on a screen. So when that number starts dropping fast, it does not feel abstract. It feels personal. Even people who understand that markets go up and down can still react emotionally because their brain is not seeing volatility. Their brain is seeing loss. And this is where one of the most dangerous myths enters the picture. The myth says the best way to protect your 401k is to get out before things get worse. It sounds logical. It sounds responsible. It sounds smart. But hidden inside that idea is a very expensive assumption. You have to be right twice. You have to know when to get out, and you have to know when to get back in. Most people fail at one of those decisions. Many fail at both. Before we go deeper, I want you to do something simple. In the comments, write one money habit, one financial goal, or one commitment you want to improve. Maybe it is, I will raise my 401k contribution. Maybe it is, I will stop checking my balance every day. Maybe it is, I will finally build an emergency fund. Write it down clearly. That small act makes the intention more real. It turns a vague thought into something visible, and that alone can increase the chance that you actually follow through. Now let's get specific about what the next market crash could do to your 401k, because the answer is not just that your balance goes down. That is obvious. The more important question is what that decline means depending on your age, timeline, habits, and financial life outside the account. If you are young and still early in your career, the crash may feel dramatic, but it may be less dangerous than it looks. That sounds strange, but it matters. If you have decades before retirement and you're still contributing regularly, a crash means the investments you buy with each paycheck become cheaper. Your balance falls, yes, but your future contributions can buy more shares. In other words, you are still in the accumulation phase. Your biggest advantage is not the size of your account today. It is time plus consistent investing. For younger workers, a crash can be painful emotionally and useful mathematically, as long as they keep going. The problem is that most people do not experience it that way. They do not think, prices are lower, that helps me over time. They think, this is bad, maybe I should stop contributing until things feel normal again. That feels safe, but it can quietly hurt long-term wealth. Because when prices fall, the investor who keeps buying is often building the future recovery into their account. The one who stops contributing is stepping away from one of the few real advantages regular workers have during a downturn. Now, if you're in your 40s or 50s, the picture gets more intense. By then, the balance may be much larger, which means the losses feel larger too. A 25% decline on a smaller account is unpleasant. A 25% decline on a six-figure or seven-figure account can feel deeply unsettling. This is where people stop thinking in percentages and start thinking in years of work. They think, I just lost what took me years to build. And that emotional shift can push people into bad decisions fast. If you're close to retirement, the risk changes again. At that stage, a big downturn can create a more serious problem because you may need to start withdrawing money soon. This is where sequence risk becomes important. If the market falls hard right before or just after you retire and you begin taking money out while the portfolio is down, the damage can last much longer. It is not just that the account dropped. It is that you're pulling money from a weakened portfolio before it has a chance to recover. That can hurt in a way that a similar crash would not hurt someone who still has 20 years left to work and contribute. That is why the real question is not simply whether a crash is coming. The real question is what a crash would do to you specifically. Because crashes do not happen inside spreadsheets. They happen inside real lives. They collide with jobs, debt, age, spending habits, family responsibilities, and the emotional habits people bring into every financial decision. And here is another issue many people overlook. Your 401k may be riskier than you think. A lot of people assume that because they are diversified, they are protected from major pain. But diversification does not mean you cannot lose a large amount in a market downturn. It just means you're not dependent on one single stock or one narrow corner of the market. A diversified stock-heavy portfolio can still fall hard. A target date fund can still surprise you with how much it drops. Many people do not discover their real risk tolerance until the market forces them to. This is also why average return numbers can be misleading. On paper, long-term average returns make investing look clean and manageable. In reality, the emotional experience is messy. The journey includes fear, uncertainty, regret, and the temptation to abandon the plan. A portfolio that looks perfect in theory is useless if you cannot stick with it in practice. The best retirement strategy is not the one that sounds smartest in a bull market. It is the one you can actually live with when things get ugly. That leads to one of the most important truths in personal finance. Investing is not only a numbers game. It is a behavior game. And this matters because when people think about preparing for a crash, they often focus on prediction. They want to know when it is coming, what will trigger it, whether they should get defensive now, whether the economy is sending signals. But most people do not need to become experts in forecasting. In fact, trying to predict every turn often creates more mistakes, not fewer. The better question is whether your financial life is ready to handle a downturn without falling apart. The next market crash will likely do several things at once. It will make balances fall fast enough to trigger emotion before logic has time to settle in. It will cause people to question allocations they never questioned while the market was rising. It will expose whether they have enough cash outside retirement accounts. It will tempt them to wait for clarity before investing again. And it will reveal whether their confidence was based on understanding or simply on recent gains. That third point matters more than most people realize. If you do not have a solid emergency fund, and the economy weakens at the same time your 401k falls, the situation can become much more dangerous. Because now your retirement account is not just down. It starts to feel like a backup plan. And once you begin thinking of long-term retirement money as short-term emergency money, the decisions usually get worse. The smartest way to protect your 401k during a crash often has very little to do with trying to outguess the market. It has to do with building enough cash outside of it, so you do not need to touch it. Cash is boring. It is not exciting. It does not make people feel like investing geniuses. But cash gives you time. It gives you breathing room. It gives you the ability to handle job loss, surprise expenses, or short-term instability without attacking the account meant for your future. That is one of the most underrated forms of financial strength there is. And then there is contribution behavior during a crash, which can shape your outcome more than people expect. Imagine two people with similar salaries and similar 401k balances. The market falls sharply. One lowers their contribution because they are scared and want more money in their paycheck. The other keeps contributing steadily. Over the following years, the second person may end up with a much stronger result. Not because they were smarter, but because they kept doing the right thing during the moment when it fell hardest. And if this is helping you see your retirement strategy more clearly, subscribe to the channel. The goal here is not just to talk about money in a general way. It is to break down the habits, mistakes, and patterns that shape real financial lives. Supporting the channel helps more people find practical ideas that can genuinely improve the way they save, invest, and make decisions when things get uncertain. Now let's talk about a trap that catches a lot of people after the drop. Recovery never feels as safe as people expect. This is a huge problem. Many investors tell themselves they will get back in once things settle down. But markets do not recover only after everyone feels comfortable. In fact, recoveries often begin while the headlines are still negative and the mood is still full of fear. The market turns before the average person feels confident again. That is why moving to cash after a big drop can become such a painful mistake. Once you sell, you do not just have to avoid more losses. You also have to make a second difficult decision later about when to buy back in. And that second decision often becomes even harder. Because now you are not just afraid of the market falling more. You are afraid of re-entering and being wrong again. So you wait, and wait. And while you wait, the recovery begins without you. This happens because losses feel urgent. Selling creates emotional relief. It gives people the sense that they took action, that they regained control. But emotional relief is not the same as a good long-term decision. Some moves feel better immediately and cost more later. So how do you prepare without pretending you can predict exactly when the next crash will happen? Start with your allocation. Your mix of investments should match your timeline and your real ability to stay invested. If your portfolio is so aggressive that a normal bear market would push you into panic, it is too aggressive for you. If you are far from retirement and sitting too conservatively because volatility makes you uncomfortable, you may be hurting your long-term future just to avoid short-term stress. Good allocation is not about being fearless. It is about being realistic. Then there is rebalancing. Rebalancing is simple, unglamorous, and incredibly powerful. It means bringing your portfolio back to its intended mix after market movements throw it off. During a crash, that may mean adding to the parts that fell most, depending on your plan. That sounds uncomfortable, and that is exactly why it works. It creates structure when emotions are trying to take over. Another thing the next crash will do is expose whether you really understand what is inside your 401k. Many people know the balance, but they do not know the details. They do not know the fund mix. They do not know the expense ratios. They do not know how much stock exposure they actually have. Then the market drops, and they start reading fund names for the first time under pressure. That is a bad moment to begin learning. You want clarity before chaos. There is also a risk that deserves more attention: too much company stock inside a retirement account. Some people let a large amount of their 401k become tied to the same company that pays their salary. That can feel safe because it is familiar. But if the company hits trouble during a downturn, you can face a double risk at the same time: job insecurity and retirement losses. One source of income and one source of wealth connected to the same problem. That is not stability. That is concentration risk disguised as confidence. And here is the deeper truth most people miss. The crash itself is not what determines your retirement outcome. The pattern of decisions around the crash matters more. The choices before it, the behavior during it, the actions after it, whether you kept contributing, whether you sold, whether you rebalanced, whether you stayed patient, whether you touched the account for short-term reasons. Those decisions shape the long-term result far more than the dramatic headlines that dominate the moment. There is another hidden factor too. Lifestyle inflation makes crashes feel worse. The more your spending rises with your income, the less flexibility you have when uncertainty appears. Someone can have a good salary and still feel financially fragile if their lifestyle consumes everything. Another person can earn less and feel much more stable simply because they built margin into their life. Financial resilience is not only about how much you make, it is about how much room you have. This is why preparing for a crash is not just about your portfolio. It is also about how you live. It is about keeping fixed expenses under control. It is about avoiding debt that steals flexibility. It is about not building a life so expensive that every market decline feels like a personal threat. Some people look wealthy when markets are rising and feel trapped when markets fall because their lifestyle left them no space. And now we get to the most important shift of all. A market crash does not only test your investments, it tests your identity. If you tied your sense of progress, intelligence, or security too closely to a rising account balance, then a falling market can feel like something more than a financial event. It can feel like proof that you failed. That is why people search for someone to blame when markets collapse. But the investors who handle crashes best usually understand something crucial. A downturn is not proof that long-term investing stopped working. It is part of the price of participating in long-term growth. That does not mean every person should respond the same way. If retirement is close, your strategy may need more stability. If you need withdrawals soon, your allocation matters more. If your risk is too high, reducing it before panic hits may be wise. But the principle remains: a crash is not automatically a reason for a dramatic move. Sometimes the smartest response is not action born from fear. It is disciplined action born from planning. So what should you do now? Know your timeline clearly. Review your allocation honestly. Build your emergency fund. Automate your contributions. Understand what you own. Write down your crash plan before emotions rise. If retirement is close, think about how you would fund the first years without selling too much from a falling portfolio, and reduce unnecessary fragility in the rest of your financial life. Because here is the strongest truth in all of this. The next market crash will not just reveal the condition of your 401k. It will reveal the condition of your financial behavior, whether you build a real system or just depend on good times, whether your confidence came from understanding or from a rising market, whether your retirement strategy can survive reality, not just optimism. That is the revelation. The crash is not the whole problem. The crash is the spotlight. It exposes weak habits, shallow risk tolerance, fragile lifestyles, and plans that were never built for stress. But it also reveals discipline, patience, preparation, and the power of people who know exactly why they are invested the way they are. The people who come through market crashes strongest are usually not the ones making dramatic predictions. They're the ones who did the boring work in advance. They built cash reserves. They controlled debt. They understood their allocation. They expected volatility instead of treating it like betrayal. They accepted that wealth is not built by avoiding every downturn. It is built by surviving downturns without self-destructing. And this is the part that can actually make you stronger. Your 401k will almost certainly go through serious declines at some point, maybe more than once. That is not evidence that your future is ruined. It is evidence that long-term investing requires patience. The real danger is not that the account falls. The real danger is that you misunderstand the fall and destroy your own plan because of it. So prepare while your mind is calm. Build the structure now. Make the key decisions before fear enters the room. Create a plan that is clear enough to protect you from your worst impulses. Then when the next crash arrives, ask better questions. Has my timeline changed? Has my need for this money changed? Is my allocation still right? Do I have enough cash outside retirement? Am I reacting to a true long-term issue or just a temporary fear? Because in the end, the next crash can do one of two things to your 401k. It can shake you out of your strategy, delay your future, and turn temporary losses into permanent damage. Or it can become the moment that proves you finally understand how retirement wealth is really built. Not by predicting every market move, not by escaping every drop, but by combining preparation, patience, and self-control when most people lose theirs. If this changed the way you think about your retirement money, subscribe and keep learning with the channel. Financial growth is rarely the result of one perfect decision. It usually comes from better habits, better systems, and better understanding over time. And share this video with someone who genuinely needs to hear it before the next downturn arrives, not after. A friend, a partner, a parent, a coworker, someone whose future could improve just by seeing this more clearly now. And if you want the next step, watch the related video on the biggest retirement mistakes people make as they get closer to their later working years, because that is often where small mistakes become expensive ones.